Welcome to What Would Peter Lynch Do?, where we explore the wisdom of legendary investor Peter Lynch. Today is May 28th, 2025. Quick market note. NVIDIA saw a bit of a dip today. Seems like folks are waiting on those earnings results. But our main focus today comes straight from one of you. A listener asked, what's the difference between index funds and active funds? Great question. And you actually sent over some really interesting material, so we're going to use that to, dive deep, looking at it through the lens of investors like Peter Lynch and Warren Buffett.
Absolutely. And it's interesting how the source material frames funds right off the bat. It calls mutual funds and ETFs a, quote, wonderful invention.
A wonderful invention. For whom, specifically?
Well, for people who maybe don't have the time or maybe the inclination to pick individual stocks themselves.
Or just want easy diversification.
Exactly. Right. Easy diversification.
Yeah.
And it mentions that both Peter Lynch and Warren Buffett have actually suggested these are sensible options for a lot of people.
Okay, so let's get to the core difference highlighted in the material. Index funds first.
Right. Index funds are, well, they're pretty straightforward. Their goal is just to track a specific market index. Think the S&P 500.
So not trying to be heroes, just aiming for the average market return. You basically own a tiny piece of everything in that index.
Precisely. And then you have the active funds. These are the ones with professional managers, teams, making the calls.
And their job is to be heroes, sort of. They're actively trying to beat the market index.
That's the goal, yes. They're picking stocks, deciding when to buy, when to sell, all based on their research and expertise, hoping to get you a better return than just tracking the index.
But here's where the source material throws in a bit of a reality check. A pretty big one, actually.
The performance data.
Yeah. It states that over the last 10 years, something like up to 75% of active equity funds failed to beat their market index benchmarks year after year.
75%. It's a stark number. That's what, 3 out of every 4 funds not achieving that primary goal of outperformance?
So why is it so tough? Does the material give any clues?
It does. It suggests a couple of things. One is that active managers often, maybe naturally, gravitate towards larger companies. The ones analysts cover heavily, the ones big enough for a large fund to invest in meaningfully.
Which means they might miss those smaller, maybe undiscovered gems, the kind Peter Lynch was known for uncovering.
Potentially, yes. They might be fishing in a more crowded, well-analyzed pond, so to speak. And the other big factor mentioned is fees.
Ah, right. Active funds cost more to run.
They typically do. Higher management fees, sometimes other costs, and even a 1 or 2% difference in fees each year. Well, it compounds. It creates a higher hurdle for the fund just to break even against a low-cost index fund, let alone outperform significantly over the long term.
That leads perfectly into the advice the source gives about actually choosing a fund. It warns against relying too much on past performance charts.
Yeah, don't just chase last year's winner. That's a common trap. Past performance, as they always say, is no guarantee of future results.
So instead of chasing hot funds, the material suggests
looking for consistency. Sticking with a fund that has a steady, understandable approach might be better than constantly jumping ship trying to find the next big thing. It favors a more long-term, stable perspective.
Makes sense. Understand what you own, whether it's aiming for the average cheaply or paying for that active attempt to beat the average, understanding the odds involved.
Exactly. It's about aligning the fund's approach and cost with your own expectations and risk tolerance.
Really valuable insights, all drawn from that material you shared. Thanks for that. Now, speaking of timeless wisdom, this show's inspired by Peter Lynch, but, let's bring in another giant mentioned in your sources, Warren Buffett.
Ah, yes, the Oracle himself.
There's that quote from his 2008 shareholder letter. Let me get it right. Price and value aren't always the same. Don't pay too much.
Classic Buffett. And absolutely fundamental. Just because something has a high price tag in the market doesn't mean it's actually worth that much based on its underlying intrinsic value.
And the key is having the discipline not to overpay, right? Even if everyone else is rushing in.
That's the core of value investing, really. Patience and discipline.
And thinking about that quote, price and value aren't always the same. Don't pay too much. The source material kind of implies this, but it feels like it goes way beyond just stocks, doesn't it?
Oh, absolutely. It's a life principle, I think. Think about how you spend your time, your energy, your attention, your most valuable non-renewable resources.
Okay.
Are you paying too much time or energy for something that seems popular or urgent, but doesn't actually deliver real value in terms of your happiness, your goals, your well-being?
So, applying that discipline, asking, is the price I'm paying in effort or stress or opportunity cost really aligned with the true value I'm getting back in my life? Am I overpaying for things that glitter but aren't gold?
It's powerful lens, evaluating choices, priorities,
Yeah.
not just investments, making sure the price aligns with genuine value.
Definitely something to reflect on, that price versus value equation in our daily lives. Well, that brings us to the end of this deep dive. Thank you again for sharing that material and prompting this discussion. We'll see you next time. This was What Would Peter Lynch Do? Thanks for joining us today. Have a wonderful day.